Hello all, welcome you to the course on corporate laws and governance. In this video, we are going to look at the evolution of corporate governance in India. If we look at the Indian economy underwent a major change in the year 1991. The government went for the liberalization, privatization and globalization of the Indian companies. If you look at it, the government allowed the foreign companies to enter into different sectors. Even many industries where we had only the public sector, that was freed up for the private sectors too. So there was a major change that happened in the economic environment of India, as a result of which what happened was we started interacting with the different countries. We had to make changes in the regulatory environment, in the legal environment, as per the requirement of the global changes. So what happened was in the year 1991, in United Kingdom, the United Kingdom government came out with formed a committee under the chairmanship of Dr. Adrian Cadbury, and this committee was entrusted with the job of coming out with corporate governance code for the companies in UK. This was the first of a kind in the world. This was the inspiration for the Indian government also, wherein our different entities like the Confederation of Indian Industries, the Association of Chambers of Commerce and Industry, Securities and Exchange Board of India, they all started constituting committee in order to give recommendation for the better corporate governance among the companies. So basically the Cadbury committee report was the inspiration for the Indian economy to go ahead with the regulatory framework for the corporate governance for the Indian companies. Now let us see what are all the different committees that were formed, what are all the major reforms that happened with respect to the corporate governance in India. We will look at it in the chronological order. The first of a kind with respect to corporate governance that we had was the Desirable Corporate Governance Code that was actually developed by Confederation of Indian Industries. They came out with their final draft in the year 1997, which actually got circulated to get the views from different experts. And finally, on April 1998, they published the Desirable Corporate Governance Code. The purpose of this particular initiative was to come out with a framework for the companies to follow the corporate governance best practices. And the idea was that this corporate governance code should be followed by all types of companies like the public company, private company, or for that matter financial institutions. Any company should be following the corporate governance norm. That was the idea of this Desirable Corporate Governance Code, which was developed by the Confederation of Indian Industries, and this was the first one to have been done in India. Next, the SEBI, the Securities and Exchange Board of India, formed a committee under the chairmanship of Kumar Mangalam Birla. And Kumar Mangalam Birla committee came out with their recommendations on May 7th, 1999. This recommendation formed the basis for creating clause 49 in the listing agreement in the year 2000 by the Securities and Exchange Board of India. In the year 2002, the government of India came out, formed a committee under the chairmanship of Mr. Naresh Chandra. That particular time in the year 2001, we had different types of scams that happened all over India. Big companies like Enron, WorldCom, or for that matter Xerox, all these companies had issues. They had financial irregularities, mainly because of the lacuna that they had with respect to the reporting of their financial transactions, and there were major corporate governance failure. This was the reason why the Government of India formed the committee under the Naresh Chandra, and the purpose of this committee was to help or was to improve the auditor-client relationship, and also to improve the integrity with which the auditors perform their duty, and to improve the transparency with which these activities happen. And the next objective of forming the committee was to make the independent directors independent in the real sense. In the year 2003, SEBI again formed a committee under the chairmanship of Mr. N.R. Narayana Murthy. The purpose of this committee was that they wanted to review the clause 49, which they actually formulated in the year 2000. They wanted to know, like, what are all the revisions that can be done in clause 49, so that the adherence of the corporate governance by the listed companies would improve even more better. So they wanted the recommendation from this particular committee to make revisions on clause 49 in the listing agreement. And in the year 2004, Government of India formed a committee under Dr. J.J. Irani. He was the director of Tata Sons. The main purpose of forming the committee was that the Indian government wanted to make changes in the Companies Act 1956. They wanted to make new provisions in the Companies Act in tandem with the requirement of the world economy as such. They wanted to make the laws very compact, and they wanted to improve the transparency and strengthen the disclosures. So they came out, they formed this particular committee under the chairmanship of Dr. J.J. Irani. In the year 2009, the Confederation of Indian Industries formed a task force on corporate governance, and this task force came out with the voluntary guidelines in following the corporate governance norms by the companies. The purpose of it is that to actually inspire or to make the companies, whether it is private, public or financial institution for that matter, to follow the corporate governance norms voluntarily, not because of the rules and regulations. In the year 2012, the Ministry of Corporate Affairs came out with the policy document on corporate governance. So this policy document was developed by on corporate governance was developed by the Ministry of Corporate Governance in the year 2012, and in 2013 the government actually repealed the previous Companies Act 1956, and they came out with the Companies Act 2013. This Companies Act 2013 was very comprehensive, wherein it had many provisions with respect to the corporate governance, and to inculcate the best practices among the companies or listed companies, public company, private company, and or for that matter a group of companies like the subsidiary companies. So all these provisions were made in the Companies Act 2013, and again the Companies Act got revised in the year 2018 and 19 in order to strengthen the corporate governance norms. In the year 2015, the SEBI came out with the SEBI Listing Obligations and Disclosures Requirement Regulations Act 2015. This was to consolidate the different listing agreements which they had for different segments of investment in the capital market. So they wanted to consolidate the listing agreements, and they came out with this SEBI Listing Obligations and Disclosure Requirement Regulations 2015 in the year 2015. The Government of India again formed a committee under the chairmanship of Uday Kotak, and if you look at the purpose of forming this committee was that there were certain areas that this committee was asked to work on. One thing was like to make the independent directors really independent when they actually do the work. This was one of the area which the committee was working on, and the next was to evaluate the board very effectively so that to ensure that they take care of the interest of the shareholders and the other stakeholders. This was another area that they were working on. Even this committee was also asked to work on the different kind of challenges that the shareholders face in the general meeting. Even that was one of the concern. Next concern was about the auditing, the accounting and auditing practices that the company follows. So this committee was asked to give recommendation to improve the auditing practices and the accounting practices that the company follows, and also to make it more transparent and to make them disclose all the relevant information to the public. So these were all the reasons why this Uday Kotak committee was formed in the year 2017. Now let's move on to the Desirable Corporate Governance Code. Let's see, because this was the first one to come out in India on corporate governance by the Confederation of Indian Industries. So let us see what are all the recommendations that the Confederation of Indian Industries gave under this Desirable Corporate Governance Code. There are totally 17 recommendations that were given by the CII under this Desirable Corporate Governance Code. Let us see each of these recommendations one by one. The first set of recommendations was with respect to the board of directors. Let us see what are all the recommendations that this corporate governance, Desirable Corporate Governance Code has dealt with for the board of directors. So the first recommendation is that this committee felt that there is no need to go for two-tier board system. Not that the company would be more efficient in its functioning if they go for two-tier board system, or for that matter multi-tier board system. A company can achieve efficiency in its functioning even when they have a single tier board system. Only thing what the board how the board should function is the board should function in such a manner that they keep the long-term value creation of the shareholders as the goal. So whatever activities that they are going to perform, what they'll have to do is they will have to keep in mind the long-term shareholders value. If they are going to have this long-term perspective of value creation for the shareholders, then it doesn't matter that a board should be two-tier or multi-tier. Even a single-tier board can perform effectively. This was the first recommendation. The second recommendation was with respect to the non-executive directors. This particular code made a recommendation that any listed company which has a turnover of 100 crores or more should have a competent, independent, qualified non-executive directors. And they have also mentioned what should be the proportion. If the chairman is a non-executive director, then the company can go for 30% of their board as the non-executive director. In the sense, the non-executive director should make up the 30% of the board if the chairman is going to be the non-executive director. If the chairman and the managing director are going to be one and the same, that means at least 50% of the board should constitute the non-executive director. The third recommendation that they have is to do with the directorship. An individual cannot be the director in more than 10 listed companies at a time. So if a person wants to be a director, he or she can be the director at the max in 10 listed companies, not beyond that. The fourth recommendation is about the non-executive directors' performance. Somewhere down the line, if we expect the non-executive directors to perform well and give their best in creating long-term shareholders' value, their compensation matters. So this particular recommendation is about the compensation as well as the active participation of the non-executive directors. These non-executive directors have to play a very active role in the board. And they cannot be a passive player. So they will have to actively participate in the activities of the board. They will have to attend all the board meetings, and they will have to ensure that they give their best in all the decision making process, and they are expected to have a very clearly defined responsibilities, like they have to be part of the audit committee, and they should give their best inputs in all the committees that they are part of. And they should have a very good knowledge in reading the financial statements, in understanding the ratios, in reading the profit and loss account, or in understanding the cash flow statements. So they are basically expected to have a very good knowledge in reading the financial numbers, like making interpretation out of the profit and loss account, understanding the cash flow analysis, interpreting the ratio analysis, so that they will have a better grip over the financial performance of the company. They are also expected to have the knowledge on various company laws. But if a non-executive director is being taken to the board for their expertise in other fields like science and technology, and then it doesn't matter, they will have to have an in-depth knowledge in understanding the financial statements. So if at all we want the non-executive directors to perform very well, they will also have to be compensated very well. So they will have to be given a commission, and the commission should be above the sitting fee which they have been hired for. So they can be given commission over and above their sitting fee. This will motivate them to give their best in all their activities. It is not only about the commission, they can also be rewarded through stock options. So when they are given stock options, it is also a part of reward for their performance. Both commission and stock options are kind of different in the sense normally commissions are paid out of the current profit of the company. So whenever we talk about the stock option is the value of the stocks are dependent on the long-term performance of the company as a whole as such. So the non-executive directors have to play an active role. They will have to have a very clear defined responsibilities. They have to be good in finance. For all that, for their best efforts, they should also have to be compensated well in terms of commission, which is based on the current profits, as well as on the basis of stock options, which will help them in getting a better rewards through the better performance of the company in future, which is pretty futuristic in nature. So when the sixth recommendation is about reappointment of the director. Whenever a company wants to reappoint a director, they will have to check whether the director had been attending the meeting in the earlier tenure. At least the director must have attended at least 50% of the meeting. If the director in their previous tenure failed to have attended the 50% of the meetings that had been held during that particular financial year, then this information has to be mentioned in the resolution, which actually would be passed before the voting happens for the reappointment of the director. So this information had to be divulged, one thing. Next, what this desirable code on corporate governance feels is that if a director had failed to attend at least even 50% of the meeting in their previous tenure, it's better they are not considered for the reappointment. The next recommendation is about the different informations which has to be reported before the board. What are all the information that has to be discussed, that has to be divulged in the board meetings? Though, let's see what are all the informations that has to be brought to the table for discussion whenever the board meetings are held. They have to discuss about the annual operating plans and budgets, including the long-term plans of the company. They will have to give information about, in fact, they have to discuss about the capital budgets, manpower budgets, and the overhead budgets. They'll have to discuss about the quarterly results for the company, not only for the company, even for the group companies, in the sense the subsidiary companies performance and the performance of different divisions of the company have to be discussed. They will have to bring for discussion the internal audit reports, even the information about the different theft that had happened, if there are going to be any kind of dishonesty which was of material in nature. This had to be brought for discussion in the board meeting. If they have received any kind of show cause notice or a demand notice or a prosecution notice from the revenue authorities which are considered to be materially important, then this information has to be brought for discussion. What is this materially important? If the show cause notice or the prosecution notice, if the value of that is going to be more than 1% of the net worth of the company, then it is considered to be materially important, and all those exposure where it is going to be more than 1% of the net worth have to be brought in for discussion. They have to discuss about any kind of fatal or serious accidents that had happened in the company, or any kind of dangerous things that has happened. This has to be brought for discussion in the board. If there is going to be any default in payment, when we say default in payment of the principal as well as default in the payment of the interest by the company to the secured creditors, or in the case of public deposits, or to the financial institutions for that matter, such any kind of default in payment has to be discussed. They have to discuss about, or they have to bring this information to the board when there is going to be any kind of default, such as the non-payment of intercorporate deposits either by the company or to the company by the outsider. If there are going to be any kind of default, this information has to be placed before the board. And if there are going to be any kind of non-payment of substantial amount of goods that had been sold by the company, then this information has also to be brought to the notice of the board. If there are going to be any kind of public or product liability, wherein there had been any kind of judgment that had been passed because of the product liability that had been created by the company to the outsiders, then this information has to be discussed. If the company has entered into any kind of joint venture or collaboration, and this kind of information has to be placed before the board. If the company has spent a substantial amount in the purchase of goodwill, brand equity, or intellectual property, then again this information has to be brought to the notice of the board. The recruitment and remuneration of the officers who are below the board level, including the appointment and or the removal of the chief financial officer and the company secretary, have to be placed before the board. If there are going to be any labor problems which the company faces, this has to be brought to the notice of the board, and they should also tell what kind of solutions that they have in mind in order to resolve the labor problems that they face in the company. They should also give details about the foreign exchange exposure of the company. They should also tell what are all the measures that the company has taken in order to protect the company from the fluctuations that are there with respect to the foreign exchange dealings of the company. The 8th recommendation is about the audit committee. Any listed company which has a turnover of 100 crores or more, or which has a paid up capital of rupees 20 crore or more, should definitely have an audit committee, and this audit committee has to be formed within 2 years from the date of achieving the turnover of 100 crores or more, or a paid up capital of rupees 20 crore or more. This audit committee has to be formed. It is mandatory, and there should be a minimum of 3 members who are the non-executive directors. That means the non-executive directors participation is a must in the audit committee. Minimum of 3 members should be the non-executive directors in the audit committee. These members, audit committee members, should have a very clearly defined terms of reference. They have to have a very clear idea about the duties that they will have to do, and they will have to be active. So normally when you perform the role of a non-executive director, the role would be relatively limited, but when you are going to be part of the audit committee, the non-executive directors who are part of the audit committee should be willing to spend more time in the activities of the company. So that is required. Their active participation is required, and they should also support, this audit committee should also support the board of directors with respect to the effective supervision of the financial reporting process, with respect to the corporate accounting or financial statement preparation. Whenever the prospectus are prepared for when the company goes for public issue, in all these cases the audit committee has to play a pivotal role. They will have to support the board in financial report preparation, financial reporting, as well as whenever the prospectus are prepared, when the company goes for public issue, they will have to play a very, very active role. And the audit committee is supposed to interact with the auditors, both the statutory auditors as well as the internal auditors. They will have to interact with them. They will have to check the veracity of the audit reports that had been submitted by these auditors. So they will have to check both the veracity as well as the quality of the report that had been submitted by these auditors, which is very, very important. The audit committee has to be provided with all the relevant information and data. Only when they are provided with all the relevant information and data by the board, this audit committee can perform effectively. So they have to be given details about the parent company, subsidiary company, information about the different divisions of the company. All these informations have to be given to the audit committee in order to ensure, or in order to help them to do their role effectively. Let's look at the recommendations which come under the heading desirable disclosure. So in order to strengthen the desirable disclosure by the company, there are some recommendations. Let's see. So the 9th recommendation talks about information which the company has to divulge under the section additional shareholders information. So under the additional shareholders information, what the company is supposed to do is, the company has to give the stock market performance. When we talk about the stock market performance of the company, they will have to give the highest price that the company has reached in the particular financial year, as well as the lowest price it has reached. This information has to be provided under the additional shareholders information. They should also give very detailed information about the turnover of the company, their operational performance, and what are all the future plans that the company has. So they have to give information about the sales, revenue, profit. They have to give a very clear idea about what are all the future plans that the company has. These informations have to be divulged under the additional shareholders information. The 10th recommendation is on the consolidation of accounts. Consolidation of accounts is optional to the companies on the condition that consolidation of accounts should be allowed by the financial institutions so that the company can take leverage of their group's asset. This is one approval that they require. Another approval is to do with the income tax department. The income tax department should be okay with the company consolidating the accounts in assessing their corporate income tax. If these two entities, the financial institutions as well as the income tax department, allows the company to consolidate, then it is optional for the company to go for the consolidation of the accounts. Whenever the company goes for the consolidation of the accounts, it is not mandatory that they have to have the annexure which talks about the subsidiary company's account under section 212 of the Companies Act. But whenever they go for consolidation of their account, they will have to define the term group very clearly, because group includes both the parent company as well as the subsidiary company. The 11th recommendation is about the stock exchange. The Indian stock exchange with which the company is dealing with, they should mandate that the companies should file a compliance certificate. Compliance certificate is with respect to whether the company has prepared its financial statements, income statement, and other accountings as per the standards that had been prescribed. So they have standards. So are they following the standards in preparing these accounts or the financial statements? This has to be signed, and this has to be this compliance certificate has to be given by the chief executive officer and the chief financial officer of the company, and they will have to clearly state in this compliance certificate that they have prepared the financial statements with integrity, and they have made a very fair presentation of the financial statements and other informations which they have given in the annual report. And they should also say that that they have followed the principles and practices which they are expected to follow as per the norms. Whether they have followed all the norms in the preparation of the financial statements, that has to be confirmed by the chief executive officer and the chief financial officer. And what they have to do is they have to say that whatever accounting statements and financial statements that had been prepared, it had been checked by the audit, by the director or by the auditors of the company. So these things have to be certified by the chief executive officer and the chief financial officer, and this certificate has to be submitted to the Indian Stock Exchange. So whichever company that is listed which has a turnover of rupees 100 crore or more have to give this compliance certificate. And whenever the company has a paid up capital of rupees 20 crore or more, what they have to do is whenever they disclose information about the company, the disclosure should be of very good quality and quantity, like how they would be doing if they go for the global depository receipt. Normally, the international norms would be very stringent when the company goes for raising money from the world, from other countries for that matter. So whatever rules that they follow in disclosing the information when they go for raising money from the international market, the same kind of disclosure have to be given by the company if they have a paid up capital of rupees 20 crore or more. The next set of recommendations are with respect to the capital markets. The 13th recommendation states that the government should give the corporate more funding against the different financial instruments they hold. So it's basically telling that the government should be helping the company by giving more finance based on the financial instruments which the companies would be pledging. The next is to do with the creditors' rights. The financial institutions, they have to rewrite their covenants in order to eliminate the nominee directors. In the sense, the financial institution can do away with the nominee directors whenever they have lent money to the companies, except in two cases. They can go with the nominee director if there are going to be any kind of serious debt default by the company, and they can go with the nominee director when the company does not provide the operational data, either the quarterly operational data or 6 month data, operational data. If the company has failed to provide that to the financial institutions, then they can go ahead with the nominee director. Otherwise, the financial institution can do away with the nominee directors in the company's board when they have lent the money to these companies. Next is with respect to credit rating. when we look at credit rating, the company would be going, whenever they go for issue of the bonds and debentures, they go for rating their bonds and debentures. A company may be going for more than one credit rating. Whenever the company goes for more than one credit rating, it is mandatory for these companies to give the rating that they have received from different credit rating agencies. All the ratings that they have got from different credit agencies should be provided to the public. This is one thing. Next is that it is not only about giving all the credit rating that they have got for their instrument, it is also about telling where they stand. Are they in the top or middle or the lower quality with respect to the other financial instruments that are there. So they will have to give a very fair view about their position in the bond market, whether they fall in the top quality category or the middle or the lower quality. This information has also to be provided. The idea is that this kind of disclosure will give more confidence and it will create a better an environment of transparency, as a result of which the public would be more willing to lend their money. The 16th recommendation is about the default in the fixed deposits. If a company has defaulted on their fixed deposits, then they should not be allowed to go for further public deposits. They cannot accept money from the public anymore when they have defaulted, and they should not be allowed to raise money through intercorporate loans until they repay the money that they have defaulted. So that's very, very important, and they are not supposed to, these companies should not be allowed to declare dividends when they have defaulted. They can go ahead with declaring the dividend only when they repay the money that they have defaulted. So these are all the things that has to be followed if the company has defaulted with respect to the public deposits. The next is about the financial institutions and the nominee directors. This is the last recommendation. The company, as we have already seen, like the financial institution need not go with the nominee director in the company's board, and it has been recommended that if the financial institution is going to have a shareholding which is lesser than 5%, or if their total holding is going to be lesser than 10%, then it is not necessary for the financial institutions to have their nominee directors in the company's board where they have made the investments. So thanks for listening.